Hey guys, Mitch here from Finance Fitness Coaching. Just want to do a video today. It's actually a two-part video. The 10 success strategies for real estate investors. Just some simple rules and guidelines that we've used over the years for our own portfolios and for our clients' portfolios. Some simple rules and strategies. So two-part video. Part one today is the first 5 in our 10 rules or 10 success strategies for real estate investors. Let's have a quick look. Okay, so number 1 in our 10 success strategies for real estate investors, get creditor proof. It's really important that we don't have our assets in our own names, but we're using assets in trusts. Multiple trust structures, multiple company as trustee for trust structures, all across the portfolio. Something that we're very much believe in here and very strong in what we do and what we do when we help our clients. We want to protect property with debt as well. So say you have a home loan, the limit of that loan is worth $400,000, but your balance is only $1. So you have the ability to redraw back up to $400,000. It looks as though if anyone was doing a title search on that property, that there's a massive debt on that property. So therefore you're protecting that with debt. So assets in trust, protecting those properties with debt, even protecting those properties that are in your own name with some debt as well. Property with high management or intensive management. So say for instance you have some commercial facility or commercial property, you have operating lease from another entity. This property is not going to be an attractive thing for a creditor to come and get it if it has management intensive buildings or whatever, which you're doing through another entity anyway. So high operating leases and stuff like that. As we're talking about leases, long-term leases that you can use, that are hard to get rid of should anyone try and take that property away. And don't forget, you can protect those properties with 99-year leases, which is a really advanced strategy that you can buy a principal place of residence in your own, in a company trust structure and protect yourself with a 99-year lease, renting back from yourself. So that's something that you can do. Also, joint venture agreements. So you could be the minor or the major partner in investments and strategies where you're doing joint ventures with people. So number 1, get creditor proof. Number 2, in part of your portfolio you want to get free and clear or very low to LVR. So you might set a rule saying, okay, in the next 15 years I want 5 houses in leafy suburbs that are free and clear or very low debt. So there's other angles or other parts of your portfolio where you're going to use debt and high leverage, but in one part of your portfolio you want a nice little solid foundation of free and clear or very low LVR properties. So set goals for parts of your portfolio. You might say, okay, everything I have in southeast Queensland that's in a leafy suburb that's north facing, brick and tile type home, I want those 5 or 6 or 7 relatively debt free within 15 years. You may set up a principal interest schedule on those type of loans, and you might then say, okay, my storage sheds or my commercial enterprises, I want to keep the high LVR on those to basically increase my yield. And remembering that when you have low LVR properties, the yields on these properties aren't as strong as something that's going to be having a leverage. So always keeping in mind on your return on investment and your cash on cash returns, which is something that we'll go through with other videos and also in detail in a live seminar coming very soon. You can protect those debt-free properties with friendly mortgages. So mortgages to your other entities, mortgages to other joint venture partners, mortgages to your mother's entity, etc., etc. So very important that you look at that, you have a good solicitor on board. Target what debts you want to pay down first. So obviously any bad debt gets targeted and reduced as quickly as possible, and then have a look at your portfolio and go, okay, what debts do I want to pay down over the next 5, 10, 15 years. You may do some chunk deals and wipe some debt out, or you may set them up on a principal and interest type payment. And if you have any private funding out there, which you should do, is negotiate well and negotiate going in. If you owe someone $100,000, $200,000 on a private lender, you can say to them, hey, I've got $80,000 today, would you take $80,000 instead of that 100? What would you like to do? So that can save you a lot of money on the long run. Number 3, get access to private money. So we want to use basically investors with us. We want to stay out of the banking network if we can. So we want to get access to private funders when we want to use these people over and over again. They become your friends, they become your confidence, they become your network around you. So use the same people that have your integrity and your vision, very much like-minded people that they can work together. Long-term people, you want to work with people for 5, 10, 15 years. You want to really help them build some assets, and you can really do well together and help each other's families all the way along. The main thing that investors want or lending partners want is you want to minimise their tax. Obviously, if they're paying tax on what they're doing, then that's got to come out of the return for the vehicle that you're doing. So is there ways that you can pay these investors back as a loan rather than as a distribution? Is there things you can do here, for that investor? Number 4, stay rich, not famous. Okay, own assets in different entities. Certain company trust structures, you might set up another wheel, another arm, as we've gone through in the Wheels of Wealth strategy before. Own assets in different entities. Don't do the same deal over and over as well. So if you're going to do the same sort of chop and flick, it's a good idea to sometimes mix up your deals with some commercial or whatever, just so you know that you're doing some stuff in different entities. Avoid class action lawsuits. Very important, don't get involved in any of that sort of stuff. It's just going to drag you through the mud. If you make a mistake, admit it, pay the price and move on. It helps everybody sleep better at night, so just move on with the deal. Don't do deals with people who want to be famous. We've all seen those people that are driving down the street in the Lamborghini. Next week or next month, they're suddenly gone and their phone's switched off. Very important that you don't do deals and associate with people who want to be famous. By association, they're going to try and make you famous, and that is not a very good thing. Do little deals more often than big deals. So there's a saying, do it small, keep it all. So do little deals more often than doing a big deal. Don't try and hit a home run on a $10 million development. Do a small $500,000, $700,000 development first. Cut your teeth on those things. Get better and better and better. And you'll probably find that you make more money on these little deals by doing them more often and less risk on the long run. Always have a solicitor on your side. It's very important that you maintain and keep a good relationship with the solicitor so you have all your agreements all in place all the time. Number 5, really important to recognise trouble before it happens. Are you low in cash flow? Are you low in equity? As in, do you have high LVRs? We have a series of rules in our portfolios and for our clients and students' portfolios that if they're between $2 and $5 million in assets, no more than 75% LVR. Above $5 million in assets, no more than 70% LVR. Above $10 million in assets, no more than 60% LVR, and so on, so on, so on. Due to the nature of our business, our long-term debts, government regulations, interest rate cycles, it's a very smart plan to think, okay, I need to have some LVR rules in place. This protects your cash flow, this protects your equity, and really stops your interest rate risk over a number of years. Are you borrowing to make payments? Okay, are you borrowing from one entity to make payments on another entity? This is a sign of trouble. There's nothing wrong with doing this on a short-term basis. If you're doing a development or a chunk deal of some sort where you're buying, using loan to pay loan, and then the end of it is a profit base. But if you're doing this on a long-term basis, you're just chewing up your equity, and this is not a good answer. You need to change things right now. Do you have a high turnover of tenants? It's really important that when we invest in real estate, the asset is represented by the income of the asset, obviously. So we want good long-term tenants. If you've got a high turnover of tenants, your rents are too high, your properties are not maintained, all that sort of stuff, that's going to cost you money in the long run. Are your tax returns not filed? Are they not up to date? How are we supposed to help you if you don't know where you sit in a position? So with a good strategist from Finance Fitness, we can look at your tax returns and we can analyse those things and look at opportunities on those actual income and profit liability statements. Are you paying too much tax? It's more than likely you are. So especially if you're a PAYG investor, PAYG employee type person, you're more than likely paying too much tax. There is strategies and ways that you can reduce that taxable income by using equity in your home to go and invest through other real estate acquisitions. Are you not sleeping well? This is very important. It has to pass the sleep test. If you're waking up in the middle of the night or not getting to sleep because you're worrying, you've done something wrong, you need to restructure your life. If something's not adding up in your life, it's time to start subtracting. Anyway, first 5 of 10 real estate success strategies. Part 2 video will be coming soon. Thanks very much. This is Mitch.